Today, we're unveiling Warren Buffett's 10 tips for investment success. Explore the strategies of this legendary investor and learn how to master the stock market. If you're ready to elevate your investments and win like a pro, keep watching. 1. Seek honest, intelligent, and talented executives. Evaluating a company's management team's quality and integrity is vital before investing. For example, when considering a tech company investment, ensure that the CEO and other key executives have a history of integrity and solid leadership skills. Investigate executives' professional backgrounds and histories. Have they succeeded in prior roles? Have they worked in the industry for a long time? Check if executives have been involved in financial or ethical scandals in the past. Integrity is essential. Assess their ability to communicate effectively with investors and the general public. Transparent communication is an indicator of honesty. 2. Control your emotions. Maintaining emotional composure and discipline is crucial when investing in the stock market. Warren Buffett emphasizes that emotions can lead to impulsive decisions that aren't beneficial in the long-term world of investment. During the 2008 financial crisis, while most investors panicked as markets tumbled, Buffett stayed focused and seized investment opportunities. He invested $5 billion in Goldman Sachs, a troubled financial institution at the time. His investment not only stabilized Goldman Sachs, but also generated significant long-term returns for him and shareholders. Buffett didn't succumb to market fear and uncertainty. He acted with confidence and discipline. Buffett shows us how emotional control, patience, and the ability to seize opportunities in times of adversity can lead to significant investment success, even during financial crises. 3. Buy quality companies at attractive prices. This approach involves finding strong companies with competitive advantages and, instead of overpaying for their stocks, acquiring them at a reasonable price or even at a margin of safety. Imagine an investor named John. One day, he read about a company called XYZ Corp, operating in the technology industry with a proven track record of success. Its products were innovative, and it had a loyal customer base. However, John noticed something important. XYZ Corp's stock had recently fallen due to a market correction and was trading at a very attractive price at that time. John researched the company further and confirmed that its balance sheet was solid and it had a competent and ethical management team. So, John decided to invest in XYZ Corp, buying shares at a price he considered attractive and with a margin of safety. Over time, the company continued to grow and generate profits, and XYZ Corp's shares significantly appreciated. John had followed Buffett's advice of buying quality companies at attractive prices, and his investment turned out to be successful. 4. Understand the business. To succeed in the stock market, it's essential to thoroughly understand the company you're investing in. Here are 3 rhetorical questions summarizing this principle. How can you invest wisely in something you don't understand? The answer is simple: you can't. Warren Buffett insists that investors must have a deep knowledge of the business they're investing in. What does the company do? How does it generate revenue? What are its competitive advantages? Why would you buy a company you can't explain to a 10-year-old? Buffett advises that an investor should be able to describe the company and its business model in a simple and clear manner. If you can't, you might be investing in something too complex or not fully understood. 5. Be patient and avoid overtrading. Who among us hasn't felt tempted to impulsively buy or sell stocks, especially when the market is volatile and financial news seems to be everywhere? Warren Buffett reminds us that, just like in life, patience is a virtue in the investment world. In a world where everything moves at a rapid pace and information flows constantly, it's easy to fall into the trap of overtrading, trying to predict every little market fluctuation. Most successful investors have learned that resisting the temptation to constantly buy and sell is better. Instead, they adopt a calmer and long-term approach. Warren Buffett has said repeatedly that the market is like a mechanism for transferring money from the impatient to the patient. Those who can stay calm and patiently wait for solid opportunities often achieve the best results. 6. Avoid price anchoring. There's a human tendency to anchor to the purchase price of an investment, which can lead to costly mistakes due to emotional attachment. Imagine an investor bought a stock at $100 per share, and over time, the stock price fell to $70. The investor might anchor to the original price of $100, thinking the stock will eventually return to that level. This anchoring to the purchase price is common and can lead to significant losses. However, stock prices aren't necessarily linked to previous purchase prices. Warren Buffett advises investors to focus on the quality of the business and not on the price they initially bought the shares at. 7. Seek assets with sustainable growth and buy with a margin of safety. Imagine you're searching for a car, not just any car, but one that will reliably take you where you want to go. What would you look for? Safety, durability, and a reliable engine, right? Warren Buffett takes the same approach when looking for assets to invest in. He seeks companies that are like those reliable cars, companies with a proven history of long-term, sustainable growth. These companies aren't just passing fads, they're industry leaders with real potential for continued growth. But here's the magic part. Warren Buffett doesn't just buy these stocks outright, he does it with a margin of safety. Imagine finding that reliable car, but also being offered it at a price below its true value. Wouldn't that be a steal? That's what buying with a margin of safety means. Warren Buffett doesn't pay the full price. He looks for assets trading at a reasonable price or even below their intrinsic value. This approach not only allows you to harness a company's growth potential, but also reduces investment risk. It's like finding a reliable car at an amazing deal. This strategy isn't just wise, it can help protect your capital and build a strong investment portfolio over time. 8. Avoid borrowing money to invest. Warren Buffett strongly advises investors not to borrow money to invest in the stock market. By avoiding leverage, investors prevent amplifying the risk of their investments. Borrowing money to invest can lead to catastrophic losses if things don't go as expected. Moreover, leverage involves additional costs in the form of interest and fees, which can significantly reduce profits from successful investments. This can make it challenging to achieve a positive net return. Another critical consideration is emotional pressure. When you have debt hanging over you, there's a temptation to make impulsive decisions or take unnecessary risks to recover losses. 9. Reinvest. Imagine this scenario. You have a seed that you keep in your pocket instead of planting it in the ground. What would you expect to happen? The seed will never grow, and your initial investment will be lost. Warren Buffett understands this perfectly. When he invests, he doesn't stop at immediate gains. Instead, he reinvests his profits, allowing his capital to grow exponentially over time. It's like growing a tree that bears fruit every year, and instead of consuming all the fruit, you leave some on the tree to grow even more. The magic of reinvestment is that, over time, the returns generated by your investment also generate returns. This creates a snowball effect that can significantly increase your wealth. Warren Buffett has used this strategy to amass a colossal fortune. So, the next time you earn profits from your investments, remember Buffett's wisdom and consider reinvesting them to see your wealth grow steadily and sustainably. 10. Monitor risk. Emphasize the importance of being aware of risks in the world of investments. Buffett stresses the need to understand what you own. Finally, this advice also encourages investors to remain calm during market volatility. Stock price fluctuations are normal, and instead of making impulsive decisions based on fear or emotion, Buffett suggests maintaining a rational perspective founded on a solid understanding of your investments.